All right, let's talk about something every business needs to know. Section 31 of the Income Tax Act 2025. This section is all about deducting bad debts. And trust me, getting this right is absolutely key for your financial reporting and, of course, your tax compliance.
So picture this, and it's a nightmare scenario for any business owner, right? Your biggest client, the one you count on, suddenly declares bankruptcy. Poof. That huge payment you were expecting, it's just gone. It's a massive financial hit. So the big question is, does the tax law offer any kind of a lifeline here? Well, the good news is, yes, it does. And the answer is hiding in plain sight, right there in Section 31 of the Income Tax Act. Now, this section is what lets you claim a deduction for these kinds of losses. But, and this is a big but, the rules are super specific. To get it right, we first need to get our heads around a really fundamental difference in accounting. And that difference is all about a provision versus a write-off. Think of it this way. A provision is like looking ahead. It's you being proactive, saying, I think I might have a loss here in the future, and you make an estimate for it. A write-off, on the other hand, is reactive. It's when you know for sure, okay, this debt is a goner, it's never getting paid. This isn't just accounting jargon. This distinction is literally the key to understanding Section 31, because the law treats them completely differently. Okay, so let's break Section 31 down. I like to think of it as having two main pillars. The first pillar, which we find in subsection 1, is all about that proactive step we just talked about, the deduction for a provision for bad and doubtful debts. Now here's the catch. Not everyone gets to use this one.
Yeah, the law is crystal clear on this. The power to claim a deduction for a provision is only for a very select club, basically the financial sector. We're talking about your scheduled and non-scheduled banks here in India, cooperative banks, public financial institutions, and certain NBFCs. So if your business isn't on this list, well, this part of the law just doesn't apply to you. Simple as that.
All right, so for the businesses that are in the club, the law sets out very specific limits on how much they can deduct. For most Indian banks, it's a two-part deal, 8.5% of their total income, and then they can add another 10% of the average loans they've given out through their rural branches. For foreign banks and other places like NBFCs, it's a bit simpler, just a flat 5% of their total income. I know. Aggregate average advances by rural branches sounds like a mouthful, right? But don't worry, it's just a fancy term for a specific calculation. All it really means is the average amount of loans a bank's rural branches have outstanding when you look at it at the end of each month for the whole tax year. It's actually a pretty smart way to give a tax break and encourage lending in rural areas. And for all you CAs and tax pros tuning in, if you want the nitty-gritty, the exact step-by-step method for this calculation, you'll find it laid out in Rule 22 of the Income Tax Rules 2026. That's your go-to source to make sure everything is computed with perfect clarity and consistency. Okay, so that was pillar 1. Now, let's move on to the second pillar, and this is the one that really matters for pretty much every other business out there. This is that reactive step we talked about, the deduction for an actual bad debt write-off. And this is all covered in Section 31, subsection 2. And here's the most important part. Unlike that exclusive club for provisions, the deduction for a write-off is for everyone. It doesn't matter if you're a tiny startup, a big manufacturing plant, or a freelance consultant. If you have a debt that has truly gone bad, this is your ticket to tax relief. So how do you claim it? The law sets out 3 conditions you have to meet. First, and this one's non-negotiable, the debt you want to write off must have been included as part of your income in the first place. You can't claim a loss on money you never declared as income, right? Makes sense. Second, there's a little alternative here, mainly for lenders. If you're in the banking or money lending business, the debt has to be from a loan you made as part of your normal operations. And finally, number 3, you have to take action. You must actually physically write the debt off as irrecoverable in your books of account for that tax year. And let me just say, that last point is so important. You can't just think to yourself, I'll never get that money back. That's not enough. The law demands a formal entry in your accounts. Seriously, the absolute cornerstone of your claim is that act of writing it off in your official books. Okay, theory is great, but let's see how this works in the real world. A practical example will make everything click into place. Let's walk through a super common scenario and see Section 31(2) in action. So let's say we have a company called Creative Designs Private Limited. They're a marketing agency, pretty standard stuff, working with different clients. Okay, so for the tax year 2026-27, Creative Designs brings in total sales of 50 lakh rupees.
They've booked this whole amount as income, ready to be taxed. So check. Condition number 1 is met.
Now, within that 50 lakhs of income is an invoice for 1 lakh rupees that they sent to a particular client. We'll just call them Client X.
And then, disaster strikes. Client X goes into liquidation. It's now pretty clear that Creative Designs is never going to see that 1 lakh rupees. So, they do the most important thing. They make that formal accounting entry and write off the 1 lakh as irrecoverable in their books. And boom, that's condition number 3 satisfied.
So what's the end result? Well, because Creative Designs ticked all the boxes for Section 31(2), they can now legally claim a deduction of 1 lakh rupees from their business income. This means their taxable profit goes down, and that means they pay less tax. That's how it works.
Knowing the rules is one thing, but actually doing it right is another. You've got to make sure you're compliant and that you don't fall into any common traps that could get your claim thrown out. So let's talk about how you can make sure your claim is rock solid. Here's a quick checklist for you. First, keep your paperwork in order. Invoices, ledgers, anything that proves the debt was part of your income. Second, document everything you did to try and get the money back. We're talking emails, letters, legal notices. This is your proof that the debt is truly bad. Third, make sure that write-off entry in your books is done perfectly. And a pro tip for companies, get a board resolution passed to officially authorize the write-off. It just makes things cleaner. And on the flip side, here are some big mistakes to avoid. The number 1 error, a regular business trying to claim a deduction for a provision. Just don't do it. Remember, that's for the banks. Another common mistake is not having enough proof that the debt is actually bad. You have to be ready to convince a tax officer. Also, never, ever try to write off a debt that wasn't taxed as income in the first place, like a personal loan. And finally, and I can't say this enough, just deciding not to chase the debt is not the same as formally writing it off in your books. All right, we've gone through a lot of detail there, so let's just boil it all down to the most important takeaways from Section 31. Okay, here's what you really need to remember. 1. Section 31 has 2 types of deductions, provision and write-off. 2. The provision deduction is an exclusive perk for specific banks and financial institutions, not for regular businesses. 3. For everyone else, the only way to get a deduction for a bad debt is to actually write it off. And 4, to claim that write-off, the debt had to be part of your taxed income, and you absolutely must have that formal entry in your books. And that's our deep dive into bad debt deductions under Section 31. You know, really understanding and applying these rules is so important for any business. I hope this explainer helped clear things up for you. Thanks so much for watching, and if you found this useful, please do like, subscribe, and share. Just a quick disclaimer before we go. This is all for educational purposes and isn't professional advice. Tax laws can and do change, so it's always best to chat with your professional advisor before making any decisions. This is an AI-generated educational video.